We're here to empower high-income earners to gain back control of your time through financial independence and stop trading your time for money and start letting your money work harder for you.
And hey, if you want to meet other high-income earners on their FIRE journey, join our High Income Earners FIRE Facebook group. Every month, we'll have guest speakers and we'll share about what our team is currently working on and allow you to share what you are working on with other high-income earners.
Welcome, everyone, back to our High Income Earners FIRE podcast. I'm Cody A. Today, Aline Prack, my co-host, will not be here with us, but we have a very awesome guest with us today, Kasey Wong. A quick intro for Kasey Wong, but I'll pass it on to him. Kasey Wong has been working in the financial service industry and then property management, has managed over 3,000 units before. And I heard that they were just refinancing a $20 million portfolio. And Kasey has been in the game for 17 years. Family man, kids, we live really close together. We just found that out. And I'm so excited to have Kasey on.
Hey, thanks, Cody. But yeah, seriously, we live really close. Just a little business background. Went to U of T, Scarborough campus.
U of T, woo woo.
Yeah, small world. Literally sort of did that financial services, went into TD Asset Management, CIBC Asset Management, Towers Parent, things like that. And I was like, read this book called Rich Dad Poor Dad. I sat on it for a good year. You probably know my story. And then Jed's the action taker. And then she read it after a year. And then she got angry that I didn't do anything. And then in 2003, basically in 2002, because we started 1 year just research. And then 2003 is when we actually started buying properties till now. And then I went to property management. Brookfield, CapREIT is some of the property management companies out there that I worked for. Cody mentioned I managed about 3,000 units. It's true. Not solely me. I had property managers. I was a property manager. Then I became a director, so on and so forth. It just kind of snowballs, but we're almost looking at 19 years. Like we're 2022 now, and I started in 2003. So it's a good run. But yeah, let's go for it. Let's talk about, I guess, our past, our present, and what we're going to be doing in the future.
So I will ask you the first hard question, but this is the most demanding question I got. I'm sure you got as well. With all these perceived risks of rising interest rate, of the new rules of 20% foreigner buyers tax, and all the rest of things, and people are talking about inverted yield curve, recessions coming. How are you guys treating all these news, and how are you guys going forward in 2022?
Basically, it's business as usual. There's always going to be noise in the short term. All this inflation that's going up, interest rates are inching up. But let's look back about 50 years from now, even when you have literally like wars or even 100 years. Overall, real estate's a very, very stable game. In the short term, there's going to be opportunity, there's going to be some risk involved, definitely. But if you strategically buy properly and you hold it for the long term, you'll do very well. So even during COVID in the last year to maybe 2 years in, we purchased some land deals. We're either going, right now, people are wanting a piece of this action, the land deals that we're buying. These are prominent locations. But yeah, there's opportunities out there. So be patient if you're listening, even if this chaotic scene of war, higher interest rate inflation, we've dealt with financial crisis in the 08 and the 09, but always hold it for the long term and cash flow it properly. You will do well. Just honestly, when it comes down to taking on your first property, if you're getting into this, buy in a better location, hold a little bit more cash. Don't be too aggressive. A lot of people, get sort of swayed, or they want to buy the cheapest because they don't have a lot of money, right? So they're trying to get the cheapest property out there, and it's going to be quite far, or it's going to be requiring a lot of capital outlay because of the deferred maintenance, things like that. My suggestion is don't do that. I've done that in Hamilton in a rough neighborhood, and I lost a lot of money.
And one of the interview, you were like saying back then you were chasing doors, you were holding your ego really high. Since we kind of talk about that, do you mind sharing with us that how do you lose money on that? Because real estate market has been going up.
Yeah.
Even since the last 19 years. So how do you lose money on that?
That's right. Good question, because we lost money, and we're actually, Jed's doing sort of our history on what
track record, right?
Yeah, it's like just tracking our record, right? So what we're doing is that we're looking at our past performance, right? How do we lose money? We actually lost money. There's a main and gauge in Hamilton. These are specific properties, 2 8 units and a 12 unit. We bought it dirt cheap. They didn't cash flow. The tenants were rough. These are steam boilers. And overall, the operating expense was quite high and tenant turnover was quite high. constantly people were moving in and not paying rent. I didn't have the experience dealing
As
with
experienced as you were. Yeah.
yeah. Even at that time, I was getting into the property management area. I lost money too. So even people going into this, not having any experience, cognizant of what you're getting into. So in Hamilton, these are the properties. One of them we bought it for 256,000 for 8-unit building. One was 299.
Let's put it into perspective. What's per door? I know that was like back then, right?
We bought this in 2005. Okay. So one was 256,000 per 8-unit building.
That's about 30K per door.
Yeah, that's right, Cody. 32,000. And one was 299. This is 959 Main Street, 821,
2005. So that's 17 years ago.
Yeah. And 37,000 per unit. The other one was, I believe, 430 or 410,000, let's say 410,000 divided by 12 units. Yeah, 34,000 per unit. So if you can see that the math right there, in 2005, they were trading about 34,000. So we bought in 2004, I bought a 10-plex in downtown Kitchener on Chapel Street. It was one of these videos. You guys can look it up. It was a white building.
Yeah, I remember that.
Yeah, it was a garbage truck going across. And then these hosts were interviewing me. I literally bought that for 430,000. There's a 10% BTB. We dropped down 15% for the deposit. When you think about it, prices were very, very low at that time. It seemed low, but that was the market. Right. And honestly, the rents were low as well. They were running anywhere from about, for one bedroom, $600, like $550 to $600. So you can see the cap rates wasn't like 10 or 20%. They were actually anywhere from about the 7 to an 8 cap. Right. It did come down. So put this into perspective, like your cap rates are coming down right now. We're in 2022, a nice little run up in a good like the last 5 years. Your cap rates come down. Your risk in a certain area it's still the same type of sort of clientele, same tenants, but now you're getting squeezed, right? Everybody's sort of, the margins are tighter now.
Cap rate compression, right?
Yeah, there's a lot of pressure. So what do people do? They're actually going to invest a little bit further. They're going to get those locations that's not as desirable. Let's say in downtown Toronto, let's say I'm not sure, your up and coming neighborhoods, Junction or whatever, I'm not sure. Those areas will start to bump up. They probably have your Scarborough area. People are investing more in the Scarborough, the boroughs, the smaller towns. It's just a natural progression, right? But also, what type of opportunities are there? There's always opportunities. We just closed on a 29-unit townhome complex in Kitchener. Not cheap at all. It's 320,000 per unit. But the opportunity is that we can condominiumize and sell it maybe, right? There's other opportunities where exactly that is that you're buying something in that you can redevelop at the back. Maybe there's extra pieces of land, right? So it's not just me. So my wife does a lot of the acquisition. We have a good team here who does the accounting, overall strategy. And you have to take a look at now, what types of opportunities are there, right? So there's opportunities everywhere. To be honest with you, I said this before, is like, there's an opportunity of a lifetime every week, right? Do you have the capability and the capital to do it, right? And the capital will follow your capability, your experience. So your capital will say, that's why they want to see our track record. Some of the capital goes, I want to see what Kasey and Jed and Cacoeli are doing. What have they done before? We're putting our history, our track record to these people, to the money partners, right? They want to see good and bad. They want to see the Hamilton, the main engage, how you lost money, or maybe some of them were kind of flat and some of them did very well. But on average, our portfolio right now our holdings is just all real estate.
You guys hold anything else?
Nope.
A little bit of insurance, a little bit of stocks, a little bit of crypto, a little bit of treasury bonds, nothing.
We have some RESPs, but it's not even enough. Like right now, I don't even, because our kids go to private school, like the UCC, the Crestwood, the little one got into Toronto French School, and then it's literally a lot of money going into tuition.
Do you mind sharing how much are those tuition now? I remember when I went through school through U of T, I came here with student visa. So I started first year with 27,000 per year. And I graduated with 33,000. So that's university though. So I don't know what's the case in private school in case some of the high income earners listening to this will considering that.
So tuition is probably about 35,000. Like we spend about 120 to 140,000 in tuition. And if they go to swimming lessons or drama class or
on top.
So we're looking at 120, like we average
per year. After
over a year
tax.
after tax money. So we gauge about 30 to 40,000 per kid for just tuition. So it's
Wow.
expensive.
It's expensive. And I think even for a lot of our listeners, high income earners, whether they're physicians, whether they're accountant, well-known lawyers, and any other like business owner, tech executive, that's still a big paycheck, right? If someone get paid 500,000, half of that goes to the government. So only have 250,000 left, and half of that goes to the kids,
Yeah,
and the other half has to keep up with their lifestyle,
that's
right?
right.
So
So I'm not driving a Porsche. I'm driving a minivan. No, but there's nothing wrong with, like, honestly, like I love cars too. I'm not a car person. I like to look at it, but I'm not, I know you're into cars. To each your own. Like, listen, if a Porsche can hold like 6 people, then I'm all for it, right? But the thing is that our kids' tuition comes first. And they're gonna say, I'm gonna tell them, like, no, I'm not giving you anything. Like, I'm not giving you a set of keys, to a car or to a house when you graduate. You go out there, pat them on the butt, go out, go earn your living, right?
Mhm.
And that's how we were like as well. My wife and I, like, we grew up.
And I think that's the best thing. Sorry, I cut you off. But I think that's the
No,
best thing you can give to a kid, or my parents that give it to me is, hey, you go out. My parents was not entrepreneur like ourselves right now. They used to work full-time job, half retired now. They don't have the business mind, unfortunately. So I have to learn everything and then get into the right group, mastermind, pay for it to grow a lot faster. But for you or for any listeners, the best gift they can give to your kids is you don't give them the money they want, what they want, right? You give them the experience and you let them struggle, but you're there to support them and let them know that it's okay to fall. So eventually, when you're not there, they have that mentality and mindset. It's okay to fall. And I think even goes to like adults too. Like some of my friends around me never failed before and they're scared to death of any failure. They're like, I'm gonna quit my job. Oh my God, that's gonna end. Hey, if I'm gonna go invest, oh my, if I lose money, oh, that's the world's about to end, that kind of thing, right? So, but sorry, I just
yeah,
hijacked your conversation, but I just thought it's so important to throw that out, the
yeah,
right mindset out.
yeah. No, you kind of remind me that the story when I take my kids out to skiing. Like, I'm not an avid skier anyway, just that my kids just want to learn how to ski. When they're learning how to ski, this is just in regular ski lessons and all. And obviously they're going to fall, right? So when they fell down, the instructor goes, quickly help them up. I go, no, no, no. I stopped them. I go, don't help them up. Let them get up, right? And I'm there, get up,
Yeah.
right? And I'm yelling at them, you can do it, you can do it. I'm just encouraging them, right? I say, it's okay, get up, get up. That's what they learn, is that, okay, well, I fall, I'm not going to cry, I'm going to get up. And to honestly, when I see my kids, when I sort of say, hey, get up, you can do it, you can do it. And then other parents quickly, helping them up, my kids learn faster, right? Because I encourage them, yell at them in a way that, come on, you can do it, right?
Not the bamboo stick,
No,
the
no,
old
no.
fashioned, the old Asian way, the bamboo
You know
sticks.
what? Yeah. It's called in the Chinese called tang tiu. It's like they'll whip it, right? But no,
Yeah.
we're not like that. But on a ski resort, right? It's like basically say, hey, go, you can do it, you can do it. So they're literally like 3 years old, 4 years old, 5 years old, and then you just encourage them. And that's how the mentality is like. Even for investing, you're gonna lose, you're gonna make mistakes. I've made so many mistakes. I had lost a 500,000
Is
in,
that from the Hamilton one?
yeah, from the Hamilton 500K, because I pay my investors back. I had my
So
roof
can you
taken.
tell me a little bit more about that? Because I think if you share that, that builds a lot of credibility for you. Because a lot of times people out there are bragging about doors and all that. But true, if you look in, right, we just had a big news about one of the investor group from
Yeah,
Saskatchewan, right? We all
yeah.
know who that is. We don't have to mention it. But really, I want to know when you run into that and how to deal with it. That was your first experience. You were like, oh my God, I took investors' money. I lost money. How do I even face myself? I promised so many things. I
Yeah,
promised positive return. I thought I have all the experience, but now flip
yeah.
upside down. So, and then you lost 500,000. How do you deal with that? I think it will build credibility again. Only share what you want to share. Okay.
Yeah, no. I'm open to this. Like, that's why our track record, we presented to future investors what our track record is. If I didn't lose money, it was steam boilers. Operating expense was expensive. Tenants were turning over. Tenants were on assistance. We still get these people. It's just that we just need to have co-signers, right? To the point where it's just constant. It was constant turnover, renovation. Places was damaged. I had to renovate it. So there's a lot of deferred maintenance. Hamilton, these buildings, they're a lot older, almost 70, 80, 100 years old. So these are a lot of things that I didn't know, that there's so much deferred maintenance and the cost of that.
Mhm.
So how do we explain this to investors? Just an open book. This is what it is. right? My mistake, nobody else's mistake. I brought them there, right?
Yeah.
They trusted us. We as operating partners, as a GP, we have a duty to ensure that the investment is somewhat safe. Like they know that their investment can go down. We told them that at the beginning. But how do I go to these people? These are my
Yeah.
friends.
How do you go back
Yeah.
and say, hey, sorry? And I'll let you finish it.
Yeah, I sold my RSPs, right, to cover for operating expenses. It took probably about 2 years to pay them all back. The principal, I think it was 2 or even 3 years, but we paid it all back, right?
So no profits on top because apparently you
Yeah,
lose money, but at least you pay the principal back
that's right.
and you spread it out in 2 years, kind of like, you know what? We're not going to default. We're not going to
Yeah,
fall, but we'll find ways to fill the hole for you. At
that's
least
right.
our reputation is there. Okay. It's not
Yeah,
successful in the first one, but I give you all your money back.
that's right.
Okay.
Give the money back. The thing is that my other properties was doing well. So what did I learn from it is that I don't want to lose a friendship, right?
Yeah.
Like I still have to see these people, right?
Yeah.
Some of them were from church, some of them were my friends. Regardless of who it is, they trusted us, right? I could easily just walk away, right? Honestly, before this Saskatoon sort of debacle of losing all this money, there's other people that lost money too.
Yeah.
So we know that it was actually sort of this investor community. They were talking, and there's another gentleman that lost money and sort of walked away. The abbreviation of his name and last name was MG, right? And that's all I'm gonna say. We learned from it. You don't know who it is, Cody.
I think it's probably a bit more mature.
Yes.
Probably 10, 20 years ago kind of thing. Yeah.
Yeah. So he just walked away, right? And then we said, no, I'm not going to do that. We take responsibility. We lost money. That's fine. I can earn it somewhere else. But put it this way, me, you, everybody, when we die, we don't take anything with us anyways, right? So be patient, be responsible, right? And real estate, to be honest with you, it doesn't make like, it's not the 20, 30, 40, 100% rate of return. It's a steady, let's say 8 to 12%. Okay. Some of it can be higher, lower, depend on what building, what location, what you're doing. But we don't say that it's going to double in this amount of year. This is going to be a 20% rate of return. No, it's going to be a very stable, it's supposed to be a very stable, secure investment in a way that you have this building, this asset as a collateral, right? So it's nothing to the point where you're making huge returns. So I'm just saying it again, but don't promise your investors something that you cannot deliver. But yeah, going back, Hamilton, we lost that money there. Some of the other investments didn't do great, but overall, when you're taking a look at the averages of all our investments, it has done very, very well. And overall, what I want to get into, like what we as Cacoeli we're getting into is the multifamily, the quote unquote smaller space at the beginning, the 30 to 80 unit buildings, something that we found that there was a dip, a lull in that type of market where a lot of investors weren't going. And when I was at Cap REIT, I can see it, that they would shy away from the small buildings, right?
Why do you think that is? Is it because big guys too small for them, small guys too big for them? Is that
right.
where it came from?
Yeah. It's simple as that, because one manager has to manage approximately 200 units. So 200 to 300, but it's usually about 200 units, one manager. Okay. So you pay a manager anywhere from about $50,000 to $70,000. They manage a building like a high rise or something. That makes sense. Anything above that, like if you're going to 10 people managing 200 units or 30, that's too many people because your margins are too tight, right? So if you're an investor and you're looking at this, make sure that your GP is lean, right? That they're not heavy on their head count, right? Because everybody still has to eat. Everybody still has to get a paycheck or put bread on the table. So if you're putting that many people in sort of in your portfolio, if you have 500, 600 houses, honestly, you're probably only looking at about 2.5 people, 3 people max managing those properties, right? You know where I'm getting at is that there's people in Saskatoon is like, come on, that's
50% occupancy rate. And, but that people didn't know, right? They sounds really great. And then they promised the return, but without going too much further in that, but I want to get that focus back on you is how are you right now going forward in 2022? And how do you communicate with your investor? I know I watched one of your video, you kind of start with friends and family, and then move to step two, kind of people are a little bit more sophisticated. They have invest as an LP limited partner as an investor in other deals before, right? And then the last step will be you go to private equity or go to a fund of a fund kind of thing, right? So can you kind of tell us like how you guys move in 2022? You guys said you just bought another building in Kitchener, right? Averaging 320 per door. So how are you guys doing that, and who are you guys dealing with, and what are you guys kind of communicating?
Oh, I see. Okay, yeah, we're actually going strictly just as an LPGP right now. We may not. We're actually sidelining. We're not going to be doing the REIT, the fund.
Oh, you guys, because back in the time when we're chatting about it with Jad was that we're going to go that route, but you guys back out from that. No more.
Yeah.
Okay.
It's a little bit more, it was complicated finding the right investors. And so a lot of our bigger investors still like the GP and LP structure, and it was flexible for them. And some of our investors want that. So we specifically work with friends, family, and accredited investors only. And if you're taking a look at the numbers and how we analyze it, we have like spreadsheets, and we have a finance person who does financial modeling, and he breaks it down to the T. So he's on our team. We hire him. He's part
like
of
a CFO kind of thing.
Yeah, he's the CFO. His name is Scott. But if you take a look at our website, he's there. He's a genius in a way that he's PricewaterhouseCoopers, PwC. And we take a look at, what are we going to do if we don't build it out? If we don't develop this piece of land, what are the returns? Well, what's the IRR of this project?
You guys bought the land. You guys want to put affordable housing on it? Is that the plan?
Yeah, right now everything is open. So if
it's raw land right now, are they zoned correctly right now, or they're not?
So we're getting the zone. So let's say you live at
SPA, kind of like set plan approval. Are you guys going through that?
Yes.
Okay.
Yes. ZPA, we're going to get the zoning plan approval. There's 4 sites that we're working on. Yonge and Steeles, which is just south of the Golden Star Burgers. You know where that.
I saw that land. Every time I drive by, I'm like, Kasey owns that one.
Yeah. So one of my developers, his name is Majid, and he's from Terrebonne. So he has a sign up there. Jane and Teston is another one. Kennedy and Steeles is another one where there's a car wash, and there's a Chinese medicinal store there. And then in Whitby, we also have one in the downtown core. So those are 4 prominent sites. What are we going to do? Everything's open. Somebody wants to purchase it. We get the zoning approval, probably sell it to a developer. We might develop 1, 2, or maybe 3 properties. We have some prominent partners that want to basically be long-term tenants. And these are government groups as well. So I don't want to divulge who we're partnering up with.
Can let us know. Let's say the most recent deal in Kitchener. You guys bought the land. What was the plan? And how you guys tell your investor and say, hey, we're going to raise money from you. There's multiple exit strategy, but how do you communicate that? And, just kind of let us know in case there's, anyone that's a credit investor and think about, hey, they might want to get involved in similar deals like that, right?
Okay. So we bought that for about 9 million, 320 per unit, 29 unit townhouse complex. Now, what we present to the investors is that in the next 3 to 5 years, we're going to condominiumize it, and then we're going to try to sell it out to the end users, or we wholesale it, sell the whole package to another operating person that would condominiumize it, sell it individually at a cheaper rate, obviously. But when we're taking a look at what condos, townhouses selling for in Kitchener, you're looking right now at, I think it's probably in the high 400s right now, right? If not more. So when we're buying like a 320, there's a quick bump once we condominiumize it to that price of, let's say, 470. Okay. So that's for argument's sake. So that's 150,000?
Yeah, 150,000 difference. So 470 and 320, the difference is 150. So
150.
For people who are kind of like, Cody, where you guys going with this? When Kasey bought it, $320,000 per door.
These are 1970s or 1980s townhouses. It's already built up. There's cash, it's not really cash flowing in a way that how we want it. It's probably zero cash flow. It's not negative cash flow. So these are regular condos or regular townhomes that's not condominiumized. We'll purchase it as a whole. Right. So it's already done. Everything is good. We just have to condominiumize. And that's literally the easy part. And then we hold it for 3 to 5 years, and then we sell it as a whole or individually. Right. As simple as that.
What are you guys going to do to it while you're holding? Are you guys going to turn tenants over? Are you guys going to change the zonings, or what are you guys going to do to add more value, or really literally just sitting there
Yeah,
kind of break even, and that just go from there, writing the principal pay down, the cash flow, and then appreciation again up
that's
in the
right.
air. But you guys are just doing that?
Yeah, we're just doing that. Like
Okay.
for now, we're gonna whatever natural turnover it's gonna happen. It's gonna happen. But the
Mhm,
exit strategy is just, number one, sell it as a whole, sell it individually. We can sell it to the tenants as a rent to own.
mhm,
There's a lot of strategies that we can do. So um, right now, in the current state of condo townhomes, as I mentioned, like let's say 470 for argument's sake, that's 150,000 bump right there. Or in 5 years, what is that going to be? Is it going to be 700? Is it going to be 800,000 per unit? Right.
mhm,
That
mhm,
too is, so we always have sort of a base case scenario where that we sell at 470. It can be up a little bit higher to, let's say, 550, 570, and then it could be up to 700 or 800,000 after the 5 years. And what is the return for that for the investors, right? So we always present, easy
mhm,
calculation that we can definitely do for
mhm,
that. We can calculate if it's going to be a 3-year project, 4 or 5, and then
mhm,
what's that internal rate of return for, because it's just time sensitive of 3 or 4 or 5 years, right?
Can you kind of share a bit about like the structure for the investors, just in case anyone's wondering the latest and greatest for this deal? How you guys kind of, do you guys have a preferral rate that you pay out? Do you charge a management fee? And do you
Yeah.
have an 80-20 split at the back end? And then on top, some bonus for the management in case you guys perform really well or anything like
Yeah.
that, or just a simple split?
Sometimes we would have a hurdle rate. So
Yeah.
in some deals, we would have that we have to perform for the investors. That's a minimum 8%, for
Mhm.
example. There could be,
For people that
and
doesn't know, hurdle rate means that if the hurdle rate is 8%, Kasey and his team will only get paid after they reach the 8% or more, right?
yeah,
That's
yeah,
the easy
yeah,
terms. Yes.
yeah. So basically another 8%. We do have an asset management fee when we
Mhm.
get the project. In this case, it was a 29 unit townhomes. There could be an asset management fee, property
Is that
management
based
fee.
on like the asset you're managing, or is that just kind of like a ballpark number you guys throw out to keep the team going and
Yeah,
all that?
yeah, it's to keep the team going. It's a nominal amount. We do have some fixed costs and all. So asset management fee, I think it's about 1 to 2%. Property management fee is usually 3 to 5% on commercial.
Yep.
Again, we have to keep these lights on the office and my
Yep.
staff. Nothing too significant. There could be a fee for, let's say, renovations or things like that
Mhm.
on turnover units. But these are based on, let's say, on gross rent, on construction or renovation costs. So it's not
Mhm.
obviously the 9 million. No, let's say I'm getting 2, 3, 4% on the renovation of $10,000, right?
Mhm.
Like we still have to pay, I still have to pay for gas, right? I still have to pay
Yes.
my time to get
Yes.
there. So it's not, you're not going to get rich on that. But a lot of the GP, they don't do any of that. Then how do you work? So we're very,
Yeah, they're basically banking on the appreciation of it, right?
yeah,
They're basically like dumping money in, and I think as a running a business, that's not a good practice. If you
no,
have one or two, yes, you can carry it. But if you have
yeah,
10, this is not a good practice, right?
that's
And
right.
that's why some of the groups can go down like that because they don't have those. Maybe they got too greedy, promised too much. They forget about their overhead costs. They need to eat too, right?
Yeah,
So,
that's a
yeah,
good point, Cody, because like a lot of people would say, okay, it's a 50-50. We don't get paid to the very end. But the very end, you may not see the very end. Like if you see my face here, I'm like, I'm shocked at how people would think that.
yeah, the
No,
traditional joint venture, a lot of new investors are doing that too. And but there are more investors moving to the GPLP structures. Not a lot, only a handful of people, right?
yeah,
And yeah, that's a very key. But I know, wow, like 40 minutes fly by. I want to bring this
oh,
back and come and bring it back to earth a little bit. And we've been going to a lot of details, but the focus of our podcast is really for high income earners. And if they want to do it themselves, they want to start, cool, learn from this podcast and do it themselves. But if they're so busy, they're like, that's not my cup of tea. I just want someone I trust and I can consult and maybe invest with, right? Then this is where this podcast is very valuable as well.
yeah.
Now, I'm going to ask you the question. I know you're heavily into real estate, a little bit RSP, but nothing else. Now, what is your version of F.I.R.E? Because a lot of people might think you already made it. And I know you have a lot of overhead costs in terms of business, in terms of our personal, the kids spending 30 to 40K per year because of private school. Like, what are your visions for your financial independence and retire early if Never retire. What's your version of when you and Jess sit down and say 5, 10 years from now, we worked so hard, it's been 20 years almost. What is that vision and say, we want to get there? That's the lifestyle. What's that lifestyle?
Okay. Good question, because I'm not the person that I'm going to sit on the beach and,
Yes.
and
No.
veg all day. And no, I'm not going to be doing that. I'm not going to be, sit at a coffee shop and just, read the newspaper. No. So we're FIRE, financial independence. I have to say, like, we're comfortable. Okay. We're still going to do what we do. I enjoy what we do, but it's not to the point where if we earn more, we get to give more, right?
Mm-hmm.
One of
Mm-hmm.
my good friends, he's a pastor, right? Let's say, yeah, he's a pastor. He studied architecture. He doesn't know I'm going to be saying this, but who cares? He likes to do what he likes to do is that he's a pastor. He likes to be on the mission field. I'm not like that. We're good at business. We're good at real estate. If we earn more, we get to give more. Okay. It doesn't mean that I'm going to get my son, my daughter, here's a Porsche. No, right? They have to earn it. You earn that, right, Cody? Your parents didn't give it to you.
Okay. Now there's a second job. I have to say something. I got
Yes.
that Porsche, did a lot of homework on it. That's the Porsche that will at least hold value or appreciate. So a lot of people thought that you can get any car, you can do that, but I treat it as a business as well. It's good for marketing. I love racing car. I took that car on the racetrack so many times, met a lot of good people, met a lot of people I can invite on this podcast. So it's all marketing. I can write those off too.
Yeah.
Right. But the most important thing is instead of looking at the monthly lease, I look at the overall cost. If it holds value and if it appreciates, just like other asset, I'm a win-win-win in all directions. So thanks for bringing that up.
But Cody, you earned it. Do you know what I'm saying?
I worked really hard to do all the homework and find out ways.
But your parents didn't give it to you. Do you know what I'm saying?
No,
your parents didn't give it to you. I'm not giving my son like a Porsche. No, he has, I'll give him a used Corolla.
Yeah, a safe car to drive. That's
a safe car, like a nice Volvo that's like a 5 to 10 years old, right? That's safe.
Yeah.
But you got to understand is that I want them to earn it. Now, going back to what your question is that, what's my FIRE? We're going to continue what we're doing. We're comfortable like what we're doing, but no, it's everybody has their vision of retirement. Maybe they want to get out of the rat race and not work. Maybe that's what they enjoy. Try it for 2 or 3 weeks, sit on a beach or do that.
I tried that for 3 days. I almost killed myself.
Yeah.
Sorry for lack of better words. I sit there, I'm like, I want to go on excursion. I want to do something like this is killing me. Right.
Yeah. But the thing is that, let's say if you like racing cars, but you can't race cars every single day, Monday to Friday, right? And nobody's there to race you, right? It's like, it's boring. So to be honest with you, like, honestly, I'll go to the office, I'll go to the buildings, do what I have to do. And I enjoy it, right? That's our sort of our FIRE. Like, Cody, if you had like 30, 40, 50,000 each and every month, right? Would you still do what you want to do, right? Are you still doing what you like? Some of these cash flows, some of these buildings provide you with good income. Yeah. Right. I will still do what I have, like I like to do. I'm not really going to sit back and, sit on a beach. Yeah. That income is great. I can put my kids to private school, buy them what they need, not what they want. Yeah. Help people like my friend who's a good pastor, and then maybe just donate to him because he's better at doing what he likes to do. And I can help him. Right. Cool. Yeah. So to each your own. Real estate is a good investment, long-term investment. Be patient. It takes the 10 to 20 years, and then you'll see the fruits of your labor. Mind you, the margins are tight. So don't think that you're going to retire in 3, 4, 5 years. It's not like that. So yes, be cognizant, really cognizant of what real estate can do. Okay.
Well, love it. So I know we said 20, 30-minute round, but it's already 50 minutes. So let's quickly go into a lightning round and then we'll wrap this up. Are you ready for the lightning round, Kasey?
Sure. Yeah.
First question. Have you become a billionaire with the B tomorrow? What will your day look like? If you become a billionaire tomorrow, what will your day look like?
Same as yesterday. Tomorrow is going to basically the same. Get up, get your clothes on, take the dogs out for a walk, get your kids ready for school. I get to invest more. I get to help more people out, but same lifestyle.
Cool. Second question. If you start all over again, let's say right now, some all of a sudden took away all your asset, but you get to keep your brain and your network. Only have 500K. So that's $500,000. You get to start all over again. The reason I ask this is because a lot of people who are listening to this podcast, they might have a full-time job, they have some money saved aside, but they haven't started investing, right? So if you were this person, but now you have your brain, what would you do starting over again?
I will look for opportunities that I can find that I can also raise. So it may not be in the GTA area. So with the 500 and whatever I can raise together, buy again multifamily. I'll strictly do it multifamily. I wouldn't do anything different. So no duplexing, triplexing, no rent to owns, 10 or 20 unit minimum. That's what I'll do.
Next question. If you were a podcast host, who would you interview?
I'd have to say you, yes. So, honest,
Like someone
honestly,
you really
I
want to
actually,
talk to, and now that you have a platform to invite
yes.
them on, who's that person? It could be alive or maybe already deceased, but
Okay.
just someone that you really want to talk to.
Actually, I'm a big Raptors fan, and I would actually interview the Raptors, sort of get into their brain and see how they're doing.
Raptors players kind of thing.
Yeah, players and
Cool. That's
just have
a
fun
very
with
cool
it.
answer. Cool. I know we talk about, working harder. You got to become more financially educated, financially capable in order to help others, right? What are some of the ways that you think you give back or you're already doing it?
I'm sorry. What? Say your question again. How I'll give back, or
Yeah. How are the ways that you think you could give back to the society or give back with, the knowledge and the wealth we have or continue to build, but how are the ways that you're giving back or planning to give back?
yeah, good question. Give back to friends. Let's say if they're in the church, I'd like to donate there. And also, we're working with some people with disability, right? And that's where some of these land deals come in, is that we're working with some of the government agencies that need good, affordable housing. And that's how we're giving back as well. So we're actually doing that right now for some of these projects.
And you can make money and help out people as well.
Yep.
Building affordable housing is not free. Like Kasey's not out there purely charity. They still make money, but there is incentive from the government to do that. And Kasey can hit two birds with one stone.
That's right.
Love it. Where can our audience find more about you?
Go to Cacoeli.com. So Cacoeli.com.
Cacoeli.com. That will be in the show notes for anyone who's driving.
Yeah, it's basically our kid's name. So it's Caitlin, so C-A, and then Corny is C-O-E-L-I is Elijah. And then literally
I was like, why do you guys, because I had a hard time like
how do you pronounce that?
Now it makes sense. Thanks for clarifying that.
Honestly, everybody couldn't even pronounce it. I was like, they couldn't even pronounce it. So we just made that name up. It's just like Mattamy Holmes. It's a Matthew and Amy, right? So that's a
really? Okay.
Oh yeah. Mattamy Holmes is Matt and Amy, the two kids' names, right? So and then we had the fourth kid, which is Chloe, but she's just not in there, so it's whatever.
You have to leave her something else.
Yeah. The asset management.
Cool. Well, such a pleasure. Like a 15-minute flyby so fast. It's such a pleasure. And it's great that, we go into a lot of depth and we kind of took a step back to kind of conclude for people who are high income earners, think about, like giving them more opportunity to look at, to potentially invest in. And thanks for your time, Kasey. Is there anything you want to leave our audience for, last note?
You know what? Follow the people that you have similar interests. So if it's Cody with the Porsche and the trading and the real estate, these are the people that you're going to build that friendship or build that relationship. It doesn't have to be with me, right? But if you have, let's say, a common interest with car racing, things like that, and he does real estate and does trading, these are the people that you want to befriend because it's going to rub off on you, right? So same thing with us. And what we do is that we have people that have kids the same, go to the same school, like Upper Canada College, right? We know people that started Cap-REIT. So the last note is that befriend people that you similar interests and you can aspire to as well. So if Cody's your friend, go race with him, share similar interests, but that's the best way to get to that next level.
Well, thanks for your time, Kasey.
No problem.
And all the links will be leave in the show notes. And thanks for listening, everyone.
Take care, guys.
All the links mentioned in this episode are included in the show notes. And if you love this episode, please leave us a rating and review on Apple iTunes. The link is also included in the show notes. And we would really appreciate your help in spreading the word to more high income earners on how they too can maximize both their time and money.
Also, if you still haven't joined our High Income Earners Facebook group, you are missing out on High Income Earners community where we help each other reach our own version of FIRE.